Welcome back to the show, everyone. On today's episode, I'm excited to have Chris Odegard with me. He is the founder of The Prolific Investor. Chris, welcome to the show.
Hey, Vijay, thanks for having me on. I'm happy to be here.
Hey, I'm really excited for today's conversation. You have a very interesting background. I mean, worked at Boeing for a lot of years, and then you started getting into the alternative investment space, and that's where I currently operate in. So I'd love to hear more about your background and kind of that transition from being an employee to getting into the space you're in right now.
Right. So, it's like some of your listeners and many Americans, I was a conventional investor. I was on, if you've read Robert Kiyosaki's book, The Cash Flow Quadrant, I was an E. I grew up with a family of E employees. That's what we did. I was taught to, get an education, get a job with benefits and work there forever. And I almost did that, but I was on that path and, conventional investments being everything that's publicly traded, stocks, bonds, mutual funds, what I call the 401k highway to mediocrity. Man, I was on that highway and it was working about as well as it does for anybody. Most people don't realize how poor a path that is. But anyway, I was on that path. And then in my mid 40s, I had my famous illiquidity event where I lost 55% of my assets and thousands of dollars a month. My case happened to be a divorce, but it could have been a medical or bankruptcy or whatever. Many of us go through something like that. And so in my mid 40s, I was like, okay, well, the choices are, well, let's see, I'm never going to recover from this. I'm going to work longer, or I'm just going to have this very diminished lifestyle when I get to a point where I can't work or don't want to work anymore. And coincidentally, around that time, a good friend of mine said, hey, Chris, there's this book. You should pick it up. It's really good. So I went out and I bought it and I sat it there, someplace in my, what I refer to as my van down by the river apartment. If you ever saw the Chris Farley skit on Saturday Night Live. Anyway, there the book sat. And finally, one day I was going on a business trip. I hopped on an airplane, took the book, and I read Rich Dad, Poor Dad from start to finish. And that's where, the clouds parted and the sun came out, and I went, wow, there is a whole different way of thinking about managing, investing your money. And I think that's a better way to go than what I've been doing in the past. And so I started going down that road. And then 9 years after that, I quit my corporate job at Boeing that I'd had for 30 plus years, and I never have to work again if I don't want to. And that would have never happened with that major setback at 45, if I had stayed on that conventional investing path. And so that's when I said, you know what, maybe I've got something here that I could share with people. I started the blog at theprolificinvestor.net, published my first book last year, Get Off Your Ass and Manage Your Money, Why You Need Alternative Investments. And so, I'm primarily an investor, but I like to share what I know because the conventional investing system isn't working for 92% of the population. I'll tell you later, if you want, why I came up with that number and how I could justify that. So that's my story.
I love that story. It's because I think Rich Dad Poor Dad, that book was a single-handedly probably the most life-changing book I've ever read. I've read it 4 times and it just switches your mindset. And it was actually, coincidentally for me, it was right when I started working at my corporate job. So it's within the first year of corporate America, and I'm like, I got to get out of here.
Good for you.
Awesome. And so, I mean, it's because of that book kind of got me in that path. And so 100% do mirror that. For the audience, could you talk about what Rich Dad Poor Dad's about?
So Robert Kiyosaki grew up and he had what he calls 2 dads. His biological father was highly educated, I believe a PhD, and he ran some portion of the education system in the state of Hawaii. So he was an educated guy, he was an employee, and then he had his best friend growing up, and his best friend's father was a businessman, much less education, but he had rental properties and he was his so-called rich dad. And so he grew up having these 2 contrasting fathers that had completely different mindsets about money and business and just life philosophy. In the end of the day, his poor dad, his biological father, ended up, losing his job, getting laid off, and being in not a very good place, kind of broke at the end of his life and in some kind of so-called retirement. And his rich dad flourished. And so he decided that the rich dad path was the way to go. And kind of that's what he talks about in his book, as well as all the laid in examples of money and investing. And the next book that people should probably read after that, if they haven't, is The Cash Flow Quadrant. And it just kind of takes that another step further. And he's written many books since then. So
Yeah, no, 100%. I know earlier in this conversation, you mentioned something about 401ks not being the best method. Could you talk about why you have that opinion?
yeah, so the 401k and the conventional investing wisdom is that you work and then you plow all this money into a 401k for two primary reasons: the employer match and the tax benefits. And at the end of your working life, you have this mountain of stocks, bonds, and mutual funds. And then financial advisors use something called the 4% rule, which says, look, if you can sell because you're asset rich and cash flow poor. If you have $1 million apartment building, you're a millionaire. But if it doesn't produce positive cash flow, you still have to have a job to live, right? So here you are at the end of your working life. You've got this mountain of mutual funds, and you have to sell off pieces of those mutual funds or that portfolio every month or whatever it is to generate the cash flow to live. So the 4% rule says that you can sell off, hopefully you can sell off 4% of those assets every year and not run out of money before you run out of life. So a lot of the questions that people ask is, well, how big does that mountain of money need to be? And I think that's the wrong question. The right question is, what retirement income do I want to have? So let's say you want to have $100,000 a year in a retirement income. So if you use that 4% formula that way and say, well, then how big does that mountain of money need to be? It needs to be $2.5 million. Well, only 8% of the population ever becomes millionaires, much less multimillionaires. So this thing that everybody is doing doesn't work for 92% of the population. The 8% that are high income earners and can put a ton of money into that 401k every year, they're going to make it. The rest of us, you are not. And then let's say maybe I'm being a little greedy. Chris, you don't need $100,000 a year in retirement. Don't be ridiculous, especially living in South Carolina, right? So I think $63,000 is about the median income last time I checked. So if you apply the 4% rule to that, it's still $1.5 million. And then it gets even better or worse, depending on how you look at it. Financial advisors are finding that the 4% rule isn't standing the test of time anymore. It's not working. So now it's the 3% rule or the 3-something% rule. So if you apply the 3% rule to that $63,000 a year income, you're up to $2.1 million. So most people don't realize that they're just never, the average American is never going to get there if they're using the 401k as their primary retirement vehicle.
What about adding in Social Security as well? Would that still not get them there, or does Social Security not pay as much?
I don't know. So you're going to add a couple $1,000s a month. Yeah, I haven't done that calculation, but
no, I'm 100% with you. I think the 4% rule, as a financial advisor, I think it's pretty ludicrous. And then so 3% helps, but still, even then, you still need a few $1 million just to live a comfortable lifestyle at retirement. So let's use this as an opportunity to shift the conversation, because we've been talking about why the old way doesn't work. So what is the new way, or the way that you found to be better for everyone?
Yeah. So it's funny when you go to, let's say you go to a financial advisor planner and you pay them some assets under management fee, and they're going to build you this diversified portfolio. Well, the 4 asset classes are paper assets, real assets like real estate, commodities, and small businesses or private equity. So those are your 4 asset classes. So in which class are you in when you go to your financial planner? I'll just use this figure, not the bad one. You're only in one asset class. So your diversified portfolio is in only one segment of the market. And alternative assets are kind of sprinkled across all of those. So alternative assets are everything that's not publicly traded. So all forms of real estate, commodities, private equity, cryptocurrency, private lending. Believe it or not, cash value life insurance is a great foundation. So, you have none of that. You have none of that stuff when you're doing that. And I've compared conventional investments to alternatives across 13 categories, and alternatives win in all but one. So think about, let's just talk about. So first of all, you have diversification is one. You have way better diversification when you're in alternatives because they span all those different categories. You have the opportunity to get cash flow. You get better returns. So the S&P 500 over its history has earned something like 9 something percent per year on average. But studies have been done. Well, what does the average investor make when he's in and out of the stock market? It's somewhere around 5%. And that's before taxes and inflation. So in this environment, if you're only earning 5% annually, you're not even maintaining your buying power. My alternative investments don't earn me anything less than 20%. And people will look at that and go, well, that sounds too good to be true. Well, it's not too good to be true. And with real estate, most of that's tax-free 20% plus annual returns. A nice thing about alternatives, as opposed to stocks, funds, and mutual funds, is you can insure them against loss. Think about walking into your Allstate agent or whatever and saying, hey, I've got this $500,000 portfolio of mutual funds. It's completely exposed in every way. I'd like to buy an insurance policy to protect that against loss. Not going to happen, but my apartment building or an ATM machine or a self-storage facility or a piece of business equipment, you can insure those all day long. Leverage. If you buy $30,000 worth of mutual funds, you get $30,000 worth of stuff. If I bring $30,000 to the table, I can acquire a $100,000 single family rental. So there's a couple key, I'm diverging here, but there's a couple keys to how well you do. And one is how much money can you invest and what are the returns? Well, when you can use a bank's money, you've just expanded greatly the amount of money you can invest. And then you've got tax volatility, you've got less volatility, tax efficiency and less volatility. So anyway, that's some of the 13. But they're just, when you look at them, it's like, why would you invest over here when there are all these advantages over here?
Yeah, I 100% mirror that. There's a lot of advantages in investing in alternative investments compared to paper assets. You mentioned that there's one thing that paper assets do better than alternatives. What is that?
Liquidity.
I was going to take a guess. I was going to say liquidity, but
yeah. So I mean, with you can get on your trading platform of your choice, Charles Schwab, Fidelity, and if you made a mistake on a buy or a trade, immediately you can sell it. If you buy an apartment building or a single family rental, but guess what? The ugly stepchild of liquidity is volatility. So they the more liquid something is, the more subject it is to these wild price fluctuations. So my apartment buildings and ATM machines, all through COVID, steady cash flow. Did they go up in value or not? I don't know. And I heard somebody say one time, the only time the price of a piece of real estate matters is twice: when you buy it and when you sell it. Everything in between doesn't matter as long as you bought it right and it's producing cash flow to at least pay for itself and hopefully throw off extra.
Got it. So using that same logic, is it fair to say it works with stocks also? The only time it matters is when you buy and sell it?
I would say that's probably true, except that except for the value of stocks is posted minute by minute, so it affects
second by second.
You're right. Investor emotion. So it probably doesn't matter. But how many people are watching that and making? That's why the S&P 500, the market index, has gotten 9 something percent over its history, but investors aren't getting that because they're watching these price changes and go, oh, I should buy, oh, I should sell, instead of just riding it out.
Yeah, you probably saw that study with Fidelity. The best performing accounts are those owned by people who are no longer alive, as in they don't trade anymore, and so people that forgot their passwords.
Yeah, I think I have heard that actually.
Yeah. So no, that's really interesting. So you mentioned ATMs and real estate. What other asset classes do you invest in? Because I want to go a little bit deeper into these.
Yeah, so I've done lots of things over kind of my investing career. When I started from small single family and multifamily units that I owned myself, and I invested in performing and non-performing notes, and then kind of around the time the Jobs Act came around, is when the doors really opened for something called syndications to be available to kind of like regular people and not just the super wealthy. And one day I was listening to a podcast, and one of the hosts said, every once in a while, you should look at your portfolio and ask yourself, knowing what I know today, would I rebuy these assets again? And I looked at the performing and non-performing notes and the small, properties that I owned, and I looked at the returns on these, and I said, these are a lot of work, and is this all that I'm making? And so over the next couple of years, I sold everything, and I started getting involved in syndications, self-storage, ATM machines, multifamily. Multifamily is really the big one for me. And if your listeners don't know what a syndication is, it's just when, if you're driving down the street and you see a new apartment building going up, it's very unlikely that one person brought the down payment or one person funded that whole thing. It's more likely that 100 investors like you and I got together and got the capital for the down payment and the initial improvements or whatever. And then we would be limited partners. And then you have the general partner who's an expert in managing this type of asset. And we just brought the money, and then we share 70-30, 60-40, depending on the deal. And you would think that you would make less money in that situation, but I'm making 20 to 30% on those before taxes on those kind of investments. And once I've decided who the syndicator is and do they have a track record that I trust, and have I met them and had lunch with them or whatever, and once I wire off my money, I'm done. And I just like to say I sit back and wait for 36 to 48 months to transpire, and then my money comes back with twice as many friends as it left with, and I go, this is awesome, right?
And then you're just like, here you go, take my money again, another deal.
And let's do it all again. And then better than that, I recycle it through a cash value life insurance part where I'm actually borrowing the money using the cash value as collateral. So I'm making money at two places at the same time.
That's incredible. Okay, so it seems like you're the LP in these situations.
Yes.
Have you wanted to get into the GP side, or is that something that you just don't want to do?
Yeah, it's kind of the reason that people become GPs is at some point in time we all run out of our own money to invest. We've borrowed everything we can borrow. We've put up everything we've got, and we go, gosh, there's all these deals coming through, but I don't have any more money. So that's, I think, when people typically go, well, I need to become a general partner so I can bring in other investors and then take a small piece of that for my efforts. And I thought that was the path I was going to go down. And I actually went to a weekend seminar about how to be a syndicator and what's involved. And I just decided that at 60 years old, that's more work than I want to do, right? And so I'm just not, maybe if I was it's basically, I had a job for 30 years. That is another job, and I have this religious aversion to trading my time for money anymore. I did that, and could I make more money? Absolutely, but I would give up a whole bunch of time freedom, and I'm just not willing to make that trade anymore.
Well, being an LP is probably the best option then.
I think it is.
So you do that with real estate syndications, multifamilies. With ATMs, do you actively operate these, or do you invest passively as well?
Yeah, it's the same thing. I go out and buy. Here's the real numbers. It's $104,000 gets me 6 ATM machines, which produce $2,155 a month for 7 years. And so basically, what happens is there's a group that not just manages my machines, but they manage hundreds of these together as a pool. Because if I had 6 machines, depending on where they were located, I would get a different amount of money every month, depending on how much traffic and how many transactions happen to that machine. But this syndication group has figured out, look, if we manage these things well and put them in the right places, we can pay Chris X amount of dollars a month, and there will be ups and downs through all the portfolio, but this number should work. And that has been going on since, when was my first ATM investment? Back in 2016 or 2018, and it just flows. Now, at the end of something to consider is this is not like apartment. This is like a used car. This is a depreciating asset. So at the end of the 7 years, they sell this thing for whatever value it is. It's old. Technology has changed. So if you spend all that money, it's gone. But think of it as a really high yielding bond, that has except you don't get your principal back at the end. I guess that's not a good example. Or maybe a high yielding annuity that you're just paying for a stream of cash. But I've done some articles on this, and when you look at bonus depreciation, you're actually looking at an internal rate of return in excess of 30%, I believe. I'd have to look at. So I mean, it's a really good, it's a really good cash flowing thing.
That's incredible. So you pay a little bit and then it's going to depreciate over 7 years and then you're still earning about 30% a year.
Yeah,
IRR. Okay.
IRR. Yeah, yeah.
Wow. Okay. So you got some real estate, you got ATMs, and you're passive on both of these. You mentioned some performing and non-performing notes, but they became too much of a hassle for you before.
Yeah, that's a really that's a really hard business. The selling point on this was, well, look, you get the advantages of real estate, but without the tenants and toilets and all that kind of stuff. So basically, you're buying the underlying debt with the building as the collateral. And I was really kind of enamored with this and buying. So you buy non-performing debt, and let's say somebody owed $100,000 on a $200,000 single family rental, and they had quit paying, so it's now non-performing. And let's say I could buy that. Those numbers, let's say I could buy that thing for 30 cents on the dollar. So for $30,000, I could buy a $100,000 obligation. Now I've got $70,000 worth of room here. I don't necessarily, these people are obviously, there's a reason why they're not paying, but I've bought, I don't have to make this on the same terms. I could extend the term. I could change the interest rates. I could push some of the debt to the back. And my objective was, how can I keep these people in their house and still make it a profit at the same time? And you've got lots of room to do that when you're buying these things. What the banks learned after the 2008 crisis, when they just inherited, all these properties through foreclosure, is that the bank, that's not the bank's business. They're okay doing that when only happens this percentage of the time. But when half of your portfolio comes, all the collateral comes back. And so instead of foreclosing, they would say, well, let's just sell this debt off. And there's ways that guys like me could get a hold of that. I'm not dealing with Bank of America, but there's kind of a flow down, and there's way that, I can buy a small pool or notes one at a time. But because you're dealing with the consumer, you have to go through a servicing company. And when you get a mortgage, the first day you're paying the bank, and the day after, the servicing at least has been sold off to somebody else, and so you had to hire a servicer, and they just all were awful. And all I ever heard from the service is what they couldn't do for me. And I'm like, oh, what are you doing for me? And anyway, rental properties were much easier than notes. And so I just kind of got out of that business altogether. And now I know plenty of people that do it, and it can be done, and people make a lot of money at it. But the other thing, too, is there's no tax advantages to notes as there is with real estate. And that is a huge deal.
Yeah, no, I agree with that. I've never invested in notes. I've done real estate. I haven't done ATMs either. I think that's actually a really interesting concept. How do people get involved or get started in these types of alternative investments? Let's say I only have a 401k, nothing else. What can I do to get it started?
Well, it's all about education, because that's one of the things that on the categories is you need way more financial education to invest in alternatives than you do to do conventional investments. Think about a young person who graduates from college, they get a job, and their employer automatically opts them into a 401k at a certain percentage of their salary, and has already picked the mix of funds that they're going to be in, and they didn't have to know anything in order to do this. So if you're going to be an alternative investor, you have to get smarter. And this is going to sound like a shameless self-promotion, but that's why I started the blog, and that's why I read the book, to try and help people. And I would say there are some mastermind groups out there that you should join, where you can be on a weekly Zoom call with investors, and they're talking about what they're doing, and they'll have a list of, here's all the different syndicators and things, here's what's available to accredited investors and non-accredited. So you really have to, the books, the podcast, the mastermind groups, you have to start changing the people that you're hanging out with, whether that's physically or virtually or both. And you want to invest in something that was recommended by somebody who's already done it, and hopefully, a person or a company that has a real track record of success. because one of the disadvantages is that these are unregulated private investments. So with the stock bond mutual fund, it's been through the SEC. It's listed on a public exchange. That doesn't mean there aren't the Wells Fargos and the Volkswagens and the Enrons. Things could still go wrong there, but they could go wrong more easily on the alternative side if you just blindly give your money to somebody who had the money to hire a lawyer and put together a private placement and say, hey, I'll be happy to take your money and invest it. You could run into trouble there.
I think that's a really important point. What do you think are some red flags you should look for when you go through these PPMs?
Oh, goodness. Well, I never want to be in somebody's first deal, right? And the PPMs are very complicated. This is where you need to get involved with the group, and many of these will have, hey, here's our list of things that you need to ask the syndicator. Here's the things and the particular places in the private placement memorandum that you should look at. And I like somebody who's been doing this for a while and could say, hey, here's the average annual return that we've delivered to investors over our last X amount of properties. In the case of the syndicator that I use, is 30% average delivered to the limited partners. That's a really good number. And, so.
Yeah. So when it comes to alternative investment education, what is, I think, or in your opinion, what is the best source to get started with, I guess, learning about ATMs or real estate or even the prolific investor? What type of material do you teach?
Well, I've got a resources. It's hard to say there's just one place, right? On the resources page on the website, I've got lists of podcasts that I like, books that I've read, and I update those periodically. So, certainly Robert Kiyosaki's books are a good place to start. My book's not bad, 120 pages. You're in and out in 2 hours with lots of color pictures and graphs. So, but anyway, I mean, that's why I started the site, to try to help people go down this path, hopefully a little smoother than I did.
I love that mission, the education. I think that's so powerful, helping the next generation. Do you have a piece of advice for anyone that's listening to this podcast about alternatives or just next steps for how they can get started?
I would say there's a couple things, and this is going to sound really corny, but I would say have a childlike curiosity. Think about when kids are little and you tell them something, they'll believe anything you say. They don't go, oh, that can't be true, because they don't have any background, for that kind of stuff. So, for example, when I tell people that I routinely make 20 to 30% average returns on my investment, a whole bunch of people just immediately close down and go, oh, that's got to be too good to be true. It must be illegal, immoral, or unethical. And they don't go past that. I remember, so I have made so much money by having an open mind and moving toward things that sounded too good to be true instead of running away from them. When I was first going down this path, and like a lot of people, I was still working. I had a good chunk of money tied up in a company 401k that I thought I couldn't move. And I was talking to a guy who was in one of these groups, and he said, Chris, go to your company and ask them if you can do an in-service transfer. My first question is, what's an in-service transfer? He says, well, that's where, the company will let you transfer some money outside the company to an outside custodian where you could invest in things other than stocks, bonds, and mutual funds. Now, I had probably been working for Boeing more than 20 years at this point, and I kind of laughed. I said, come on, if that were possible, certainly I would know about it. Having worked here, having been around all kinds of people. And so I did what I'm telling you not to do. I just kind of dismissed it. And one day I was at the office, it popped back into my head, and all I had to do was get on the company site, and sure enough, the company would allow me to do an in-service transfer of all of the matching money that they had made over the years. And so I was able to take that out, and that, helped give me a chunk of money to start investing in alternatives that I wouldn't have, if I had just said, that's got to be too good to be true, move on, I would have missed that. So, childlike curiosity.
I think that's very, very powerful. I'm in the personal finance community, and so my whole goal is to get people to just start investing. I feel like the basic step is completely missed, right? And then you're going a step further. It's like, great, now you're investing in stocks. Let's go a step deeper and get you better returns and kind of optimize it. So how do you bridge that gap between people who are just starting to invest and they're like, yeah, this is good. I don't really want to learn. I don't want to spend time learning because they're making good money. They're investing in index funds. How do you make that gap or that jump between the gap?
I think the most powerful thing, and unfortunately I had, is what we talked about, the 4% rule. And unfortunately, I didn't kind of put that whole math and scenario together until after I had written the book, because that would have been right up there in the opening chapters. But that would be something that I would share, and I've written that article. And that is, I don't know, I can't think of anything that's really more compelling than that. If you share that with people, and they still just go, I mean, there's two things. Either people, you know, there's nothing wrong with working, and I've heard people say, look, if you love what you're doing, it's not really work. But at some point in time, people are going to want to not work, or they're not going to be able to work. So for all those people who love their job, that's fantastic. But somehow you got to plan for that day. So if people look at that information and just don't care, well, there's two reasons. They're either they do care, but they're scared and they don't really understand or believe it, or they don't care because they really just don't care. And you can't really help that. You can't really help those people. Man, if that doesn't pique somebody's curiosity, I don't know what will.
Yeah. So you're saying just kind of help them out and help them kind of realize the trajectory they're currently on, unless they start investing in alternatives.
And over the years that I sat around people, when I was still working, and they watched me do this, and I can tell you from personal experience that 8 out of 10 people won't change anything. And that's what Jim Rohn calls the mysteries of the mind, right? So you're only going to get about 20% at best. So, you just got to know that. It's kind of, but hey, 20% is better than nothing, right? I mean, I always look at, of all the, think about the pandemic, of all the problems that people have. If you could just take money off the table as a problem, how much better would everybody's life be? I mean, it's not everything, but if people went through their life and they didn't have to worry about money, man, everything would be a lot easier, right?
Absolutely. I remember at the beginning of this podcast, you're talking something about 92%. What was that number in reference to?
That's the amount. Let's back it up. 8%. If you do some homework and say what percentage of Americans achieve millionaire status, it's 8%. So in order for the 401k portfolio to work depending on anything above the $63,000 mark, using the 3% rule or the 4% rule, you have to be a millionaire or better. And 92% of the people will never get there.
So I can tell you're extremely passionate about this, and I love that. Where can our audience get in touch with you?
Yeah, the easiest place to go is to my website at theprolificinvestor.net. And every way to contact me, all the social media, the articles, all the resources and videos are all there. So that's the one-stop shop.
Perfect. I'll put all this in the show notes. Chris, it was an absolute pleasure having you on the show. Thank you so much for your time.
Yeah, it was an honor. Thanks for having me on. Appreciate it.